Fantastic. Cool. Right now it's 10:14, so we maybe get started a little early with that hour-long Friday group Q&A session where we're just gonna again have fun, talk, recap our week, plan for next week, stock-related stuff. It can be anything. Be how do I budget my money, Josh? Right, I suck at budgeting money. How do I do that? All right, it could be anything finance-related that pertains to like education, not advice. We're gonna have fun with it and see how it goes. All right, so we are officially live. You guys are live as well. So we can start now. We can officially dive into this at 11:30, but hey, we can at least build some momentum here. We can at least build some momentum here leading up to that 10:30, guys. They're saying, is there any reason the setups you look for on smaller time frame wouldn't be validated in a larger time frame, assuming, of course, it would just simply take more time to play out? I'm asking because I think I need to transition into swing trading in the meantime while my time is going to be a bit more limited. I don't want to stop trading. So it really depends, right? Like, let's say a dip buy, for example. You're not going to really get a dip buy on a daily time frame because that's really it's a really high frequency scalping opportunity in the market. Those dip buys and a lot of intraday short-term price action is what really validates those kind of trades, right? From looking at the level to the time and sales price action, 1 minute time frame, volume, dip buy level. So that would be like one of those, say, setups that wouldn't really play out on a like daily time frame or a larger time frame, for example. But something like, let's say, your typical double top with divergence, cracking a daily trend line off resistance, right? Like one of my favorite short strategies is when we see a double top at or near level of resistance, we see validated divergence. We're starting to crack a trend line as well, right? You can see those on daily charts. Absolutely. Fibonacci retracements into supply zones, extensions into demand zones, going long and short, playing market mechanics, playing uptrends, downtrends, reversal formations. Yes, they would all apply on those higher time frames. Absolutely. Absolutely, boss man. 100%. Thought I could help. All right. Good question, though. Good question. I love it, man. So, right now, we had a nice trade on NVST. Nice trade on BRQS. No, not a nice trade on BRQS. We didn't touch that one. We did not touch CYTO, but that one, not too shabby. All right. Run your trend line. You could still have a nice little trend line opportunity. Boop. Here on CYTO if we ever come back down to it. You like that stir? Did it feel a lot better, guys? It felt good for me. It felt fucking fantastic. I'm not going to lie. Just it was like a weight taken off my chest. It was good. Nice. Appreciate you, boss. Appreciate you. So, oh, way to get it, you guys. You guys are crushing it. Look at H. H on APE getting a quick 36 bucks. Look at Skylar over here locking in $2,000 on the day. What? What are you doing over here, bro? Look, locking in $2,700, $2,600 on Tesla. Get what? What? That's crazy, man. You got Mr. G over here just crushing it. Y'all crushed it yesterday too. Corey, nice day. H kept the loss nice and small, down $5. Way to manage your risk, bro. Way to manage it. Mr. G crushing it. Skylar yesterday crushing it. Good job, traders. Good job. Good job. Skylar's over here robbing the bank. So let's make sure we're not missing anything. And then we will officially dive into our hour-long Friday group Q&A session. And really what this is for us to be able to jump on the Zoom call. And you guys can ask me questions. You guys can ask anybody a question that's willing to answer to help you. Share screens, review trades, talk about this week and recap, getting prepared for next week, shoot the shit, have fun, just talk about growth, education, advancing, leveling up. I mean, anything that has to do with becoming the best version of yourself and the best trader, the best man, woman, husband, wife, father, whatever. That's what these are for. These are just great ways for us to end our week on the most positive note possible. So SPY, anything here, we're coming right back up into the 20 EMA. It's a level to be worth watching. Right around that 370, which is also right around that trend line that we discussed. We have potential to come back up to today before getting rejected and seeing the markets come back down. Same thing with the Qs. Qs are grinding their way all the way up into that daily downtrend, and that's an area where I expect to see the markets top on out, then come right back down into the trend line underneath these lows. And so that's going to really dictate, hey, when do I want to get in with NVIDIA? NVIDIA is still getting rejected right below that 20 EMA, right? So if we see the SPY hit that trend line and start dropping, the Qs hit that downtrend on the daily and start dropping, that's going to put NVIDIA still below its 20 EMA. We could start to see it drop today. That's a killer day trade, in my opinion. I like it. I'm taking it. Followed by something that turns into a nice little swing trade. So I'm still keeping NVIDIA on high watch. And then still just kind of watching everything else as well. See if Netflix ever gives us anything. But yeah. We're good, guys. No AMPX, nothing. PEGY, done. CYTO, done. MVST's done. So that's our day. We come in, first 30 minutes, 45 minutes. Find the opportunities, take advantage before things start fading on off. And we were able to lock in $700 on the day. Job well done, traders. Job well done. Mic's now open. Let's go ahead and start a little bit early, guys. If anybody wants to talk. Let's see. Alpha, do you think Amazon's strong resistance around 113 area? It touched that 3 times on the 5-minute time frame on the last 3 to 4 days. Let's go look at Amazon. My keyboard would work. AMZN. Do you think Amazon has strong resistance around the 113 area? It touched that area 3 times on the 5-minute. Is that the wrong 113? What do you mean? So we've come down. Yeah, and okay, support. I hope you're, support, right? Because we've come down and tapped that area really nicely over the last, 1, 2, 3 days, right around 113. That's pretty nice support here on Amazon. And then what we do see is you got a little bit of this downtrend on Amazon at this point in time. So flat support with these lower highs forming. Look at your daily chart. We're still below that 20 EMA. So as long as we stay below that 20 EMA, it looks bearish. We're below this downtrend. It's bearish. And if we ever see the crack below 113, we can definitely start to see it come back down towards around that 105 level. And that really, depends on what's the SPY going to do at this daily downtrend, right? It's inside like this megaphone formation where you have a downtrend off the highs, you have a trend line off the lows, but those trend lines become more separated as the days go on, and you see bigger moves in between those two levels. Right? They call that a megaphone formation, falling channel, whatever you want to call it. But yeah, so we're coming into this downtrend and we get rejected, and the SPY has high probabilities of coming back into this lower a trend line, that puts you at 360 from 370. That's another 10 points to the downside. That's definitely going to pull NVIDIA down along with it. And that's definitely going to pull Amazon down along with it as well. So it really depends on what the SPY and the Qs do. And if they start selling off those downtrends, that puts Amazon at its downtrend, puts Amazon right below its 20 EMA, and then boom, you're sitting right at resistance, have room back down to 113. Same thing applies to NVIDIA, right? NVIDIA, if the SPY and the Q start selling off those levels that we just discussed, well, NVIDIA is sitting right below its 20 EMA as well, and you've had 1, 2, 3, 4 days of just getting rejected. Every time it comes up and gets rejected, it falls off. Every time it comes up and gets rejected, it falls off. Comes up, gets rejected, it falls off. So if we see this continue to play on out, comes up, gets rejected, and we start to pull back a little bit, well, it's a nice low-risk area to get involved here with NVIDIA. We do have some decent potential to the downside. No, you're good, man. No worries. Absolutely. 100% H. Hopefully that answers your questions. Your question, yes. I really like to see what the SPY is going to do up around that level, which it already looks like we're getting a pretty nice rejection. Pretty darn close. Right? And we could probably readjust that trend line just a smidge and probably see that it's already come up and tapped that trend line, even if we brought it down a little bit. Still running the trend line off these highs. Still great connection points. We can see that we pretty much came up and tapped that bad boy to the penny. Pretty darn close around that 370, and we're getting rejected now. We're starting to kind of sell off. So still want to keep the SPY on watch and see if we're going to continue back down into the low 360s. Same thing with the Qs. See if we're going to continue back down into the mid 260s and see how that impacts NVIDIA. It did come down to that 875. Dang it. AMPX did come down to 875. I missed every bit of that. That would be a really good setup. Forget it. That would be beautiful. I'm going to try TradeStation. TradeStation seems like it's a good all-in-one. I'm going to start trading futures. I'm going to trade more options. And then obviously day trade. And I guess their platform is like really good for like everything. TradeStation. Good for scalping. No commissions and fees. I guess the orders are good, like Fidelity, price improvement. Trade on chart, drag your... I guess it's really good. I'm going to try them out because if it's a good all-in-one solution, I don't need Ninja Trader up. I don't need Fidelity up. I don't need this and that. I can have everything right in front of me. I'd be like, boom, I want to be in an AMPX right there. 875. In. Stops. 850. Did anybody catch AMPX off the 875? That was our back burner sleeper play pick this morning, and it's already up pretty decently. You already got a nice 80, 90 cent pop there on AMPX. I hope someone grabbed it because that was I mean, again, those back burner sleepers, like I said, they may be really hard to trade them intraday from a movement, volume, price action standpoint, but from levels to levels, they work fantastically. They're freaking beautiful. So, I mean, to your 875 level to the penny, now you have room to 10 and 1148. I hope you guys grab some of that if that was your one pick of the day, and hopefully you guys are going to lock in some profits. Hey, Corey, it happens to the best of us, man. It happens to the best of us. We got a lot going on.
The reason why I didn't is because I was already involved in the SPY.
That's why. Yeah, you don't want to have too many open trades at the same time.
But still.
Right, yeah. Hey, I'm the same way. Why don't I take my own advice like this morning? AMPX, 875 entry. I could have had something typed up in this. I'm ready to go. Now I'm already looking. I'm like, oh, yeah, it's already popped up a nice dollar there. Hey, it happens to the best of us, man. It's not like this is Pokemon, all right? You can't catch them all. Funny was. And nothing. Anyone trading Snap today? Nope, I'm not trading Snap. If it gets down to like 7, I may look at it for a dip buy, like an intraday dip buy, if it just comes crashing down to 7, which I doubt it. It could. I mean, it's already down more than 50 cents from high day to where it's at now. So another 50-cent drop to the downside into that daily gap fill level at 704. Yeah, absolutely. I would take a trade there if the price action looks good. I'm also going to be buying some Snapchat today. I mean, maybe 100 shares just to start and get my feet wet. It's only a $700 investment. Be 200 shares. It's not a lot. It's barely anything from like a capital standpoint. And I think it could be something worth holding for, you know, a few years out and see whatever happens. It just seems like really, 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 really low risk with a lot of potential to the upside. Speaking about it, let me just go ahead and get in there and estimate. And I'll probably just, you know, throw 100 shares at it today and come next week, kind of see where the markets are going. Don't we have FOMC next Wednesday? Is it next Wednesday? Thursday. It's next week, right? Like the last week. All right, so I grabbed a very small amount. If there's anything else that I want to cost base right now? No, nothing. All right. We're in there. So you got one on November 1st through the 2nd. Okay, cool. So it's okay. So we have some time. That's going to put us out until not next week, but the week after, and the conclusion is on the Wednesday. Okay, at 2 p.m. So we'll have the Fed's decisions next. I'm just kind of scanning across the board, like, you know, are there any good day trades? I don't really see anything right now at this point in time. The only thing that I'm watching, which I feel like, you know, the entry is a little late, seeing how quick the Qs have pulled back in the SPY, which makes me feel like I'm chasing this NVIDIA position. I'm going to wait for the SPY and the Qs to bounce. That's going to allow NVIDIA to bounce. If we start to see that lower high come in and we're still convicted that, you know, we're going to roll on over in the market, then I'll start looking to get a position there on NVIDIA going 40, I think it was the 43 days out. It was a 110 strike for about 600 apiece. It'll be cheaper now, which is great. So if you look at it, NVIDIA, a little bit less expensive, 42 days out, 110. They were 110. Yeah, they're 550 now. So it's perfect. Andy, AGFY. And let's just make sure we're putting in the tickers in correct ticker format too. No worries, no apologies needed, Andy. So you're good. Just future reference, let's put those dollar signs in front of the tickers. But you got stuck in it yesterday. Okay, so at least you didn't get stuck in this thing like last week, right? Like last week. So what's your price? What's your cost basis on it? Because like honestly, you know, if you got in the 220s, you're looking pretty decent. 250 yesterday, yeah. I mean, I would say if you come cracking below like $2, you definitely don't want to be in it. But you know, here's what I would think is a lot of these reverse stock splits a few days after get action. Like we've been seeing that in the market. Now it's super risky to hold that because it's 100% speculation. There's no edge. You're kind of hoping that something happens with this stock after the split, right? That's what you would think. But what I see is yesterday is a pretty strong day overall as far as volume. I mean, there was about 14 million shares traded. You hit a 52-week low today, obviously at 225. You see you have really clean support right there around that 220 to 225 area. And, you know, some of our stocks lately have been stocks that come off high volume days, putting in 52-week lows, and then they start screaming the next day. And on top of that, you just had a 1-to-10 split. We've been seeing a lot of these splits absolutely rip and run. So is it risky? Yes. Is there a lot of potential reward if you see that play out? Yes. Are you okay with risking 50 cents a share on the trade? Because that's what I would do. If I'm in at 250, I'm throwing stops for $2 just to let it breathe a little bit. How much room to the upside do you have? Right? You know, from a technical perspective, back up towards around 366. Got 366. Then back up towards around 450 to 5. You got to think like that's 100%. If you get to $5, that's 100% from where you're at now, and your stop loss from your cost basis of 250 down below 2 is 20%. Yeah. So got to weigh out the pros and cons. Are you willing to risk 20% of your investment to see if this thing does move off that reverse split? Because that's just what a lot of stocks have been doing. I mean, it's very risky though. All I want to say, it's just very, very risky. Got to weigh out the pros and cons. Like you got to be okay with just risking the 50 cents and you're really just hoping it gets back up into the $4, $5, $6 area. It's really, you're just hoping. But you have seen a lot of stocks just absolutely random look just like this after a split, volumes moving on in, you're finding support, they just freaking take on off. So I wouldn't really, today's not really a day. It seems like for the open floor little thing, I got to build more hype around it, some more anticipation, so you guys know that we're having it, what they entail, kind of get you guys out of your comfort zone a little bit. But they're a complete open floor. You can jump in, talk, speak, questions, ask this trader a question, this member a question. I mean, it's completely open floor, and it's really good to help end our weeks strong. Just from a mental standpoint, just wrapping up these weeks, recapping them, and just getting some, preparation and momentum to bleed into next week, guys. So we'll probably keep it open for another 5 minutes. If we have anybody that has any questions that want to jump on and participate and engage, definitely let's do it. If not, then we'll go ahead and end our Friday the time that we normally end our Friday, which is typically right around 10:30, but we'll go around 10:45 to 11 o'clock.
Hey Josh, it's Matt.
What's up, man?
Hey, one of the things that I don't know if you ever really talk about, I know we talked about the coin flip around earnings plays.
Yep.
For taking calls or puts or whatnot, and trying to buy like a contract or two or whatnot. But I don't know if you've ever talked about the premium push around earnings.
Yep. From ID, like an implied volatility standpoint.
So yeah, to speak to the group, the implied volatility increases so rapidly around earnings time that a 10-day out option that is about to hit earnings inside the next 3-4 days, 5 days, is on a 10-day is normally 2 to 3 times what the option price would normally be after the earnings is over. So a week after earnings is done, that you can look at a 10-day at the same type of delta. So you're comparing apples to apples, and that same option has decreased by 3 times what it would have been around earnings time.
Around earnings.
So you're paying more around earnings time. So
you're talking like 10 days before earnings. So for example, if you have earnings next Wednesday on Apple,
right,
this prior Monday, the Monday of this week, you could have been looking at 10-day out contracts, just, looking at, those possibly going to the X, what those premiums are, because the implied volatility is going to increase ahead of earnings.
So yeah, so right now on Apple, you could look at, let me pull my strikes up.
One of their earnings, they actually have earnings on the 27th. So yeah, next Thursday. Yep. So yeah.
So on Apple selling at 144 right now, you could pull up like a 142, right around a 40 delta. So $2 shy of of at the money.
On a put or on a call?
On a put.
On a put, and you're going 7 days out?
Yep.
Okay.
Well, it's right now 7 days out, just because there's no 10-day out contract.
And you're like a 140, so that's 227 with a 52% implied volatility.
Yep. So you would have almost $3 of premium on the same 7 to 10-day out type option. That would be around $1.10 to $1.50 or so.
What those normally would be is around $1.10, $1.50.
Yeah, and the 142 is close to around is right around $3 or so, and everything. So that means if say you took, let's move it out to a 14-day, just because it's a little more out.
Okay.
On a 14-day, the same 142 strike on a put is about $4.
About $4. Yep.
Apple has historically never missed earnings outside of one outlier. It rarely misses earnings. They intentionally lowball people. So if you were not buying the put, but actually selling the premium, you'd get $400.
Yep.
Off of a contract. And everything. So in a week, so 1 week after that, next Monday after, if Apple doesn't even move, if you bought the option, your option is probably only worth $1, maybe at the best case. If it doesn't move, it moves up in your favor, and the stock moves up, then that's great. Premium's worth even less.
It's worth less. You get the $400 if you're selling it.
But if
you're not exercised or anything.
Let's say earnings report comes out and they lose and they drop 10% or whatever, because normally it's anywhere between 5 and 10%. The stock will move.
Yeah. So let's say it's down to 130,
and
you got a 142 put that you sold before earning.
And so I guarantee if you look at something that is off by 5, 10, actually, you know what? Let me pull up the on demand for a second. On demand, I'm gonna pick a random day after the last earnings would have been August 16th. And I'm gonna go 10% below what market was. And let me pull up what market was. August 16th. Earnings report came out July 28th. So I'm gonna be too further out. 10%. So yeah, so even on a 10% drop, or assuming a 10% off, it's still selling at 347. So that means you would have sold it for 400. You would have made $400 on the original purchase of the stock.
Right.
The stock does the exact thing you don't want it to do and drops. It drops 10%. And a week later, you're looking at the option because the implied volatility was so high, it's now come back down to earth. And since it's come back down to earth, even though the stock's gone down, you're actually still up $60 on this trade.
Oh, wow.
And the stock has dropped.
Premium too. Yeah.
Yeah.
How does that work with, the whole, obviously selling cash secured puts, right? If it's at or below the strike that you sold, exercise and you're assigned those 100 shares. So you still have that risk potentially of being assigned 100 shares for $14,200.
Yeah, so what would happen is if shares get assigned, they would you'll get an email and you'll have the option to either close out of the trade within 24 hours.
Buy the contract.
You have to rebuy the contract, or you accept the shares and you acquire 100 shares of Apple.
So you sell the cash secured put for $400, and let's say it goes against you, this and that, you get the email, and let's say it's $350 to buy it back. You would lose $50 in that scenario to rebuy that put contract back at $350, and you sold it for.
You don't lose 50, you make 50. So you were paid 400.
Correct. But if you have to rebuy that back.
If you have to rebuy, it costs you $350. So you still are profiting $50.
The 50. Okay. Gotcha. Yep. Or like you said, you could, get assigned those shares and take delivery, and then you own Apple at 142 a share. Regardless.
Absolutely.
Of the price,
and then you go onto the call side and throw some covered calls on you until you sell out of there. If you acquired the shares.
Gotcha. Yeah. And that was something we were talking about earlier this week. Catherine jumped on, was asking about, not even asking, saying that she, does a lot of, cash secured puts, writing covered calls, and she's been making a crap ton of money in the market doing that. I'm like, I wish that was one thing I would have done before diving into like the education and the coaching, the mentoring with like penny stocks and small caps and TA and mindset, was actually had more of an understanding on this because that's a really nice passive thing to be able to do. And it's nothing like active that you have to be in the zone in the moment, like scalping a stock.
You don't. You literally can be doing anything you want. You just are programmed for 5-10 minutes, make the trade.
That's it.
Go about your business, and
I'm going to maybe manage it.
It's better to manage your trade. Don't get me wrong. You don't want to set it and forget it type thing, but you don't have to be hawk-eyed at the screen.
You can look at it periodically throughout the day and just kind of look at what kind of moves, because it's not like it's making $10, $15 moves in it.
No.
So you don't have to worry about that extreme volatility or those.
And as long as you're running it as at a 10 to 20% discount, I mean, I run it's called the wheel strategy, the whole revolution of the thing. So you sell cash secured puts, and then if let's say you do 30 days, in 30 days, it comes and goes. Then say it didn't fill, so you go and do it again and do it again. Eventually, the stock goes down far enough, it hits you.
It hits you eventually, and you get assigned, and then like
and then you get assigned, and now you go on to the other side on the call side, and you sell the call, but you sell it at a point that is above your entry. So if you were assigned at 142,
you still make money on
145, 150.
Exactly.
So you at least gain some positive. Now, the negative in this is maybe when you were assigned on the put, it's super, like the stock drops super low. Like on this one at 142, let's say the stock dropped to like 120.
You'd be like, shit. Yeah, exactly.
And so when you go to sell on the covered call side, you'd be selling at 142, which is your cost entry. And you'd be selling at like 145, 150, and you're not going to gain much. You're going to gain.
The premium's going to be at 50 cents dollar. Yeah. If that.
Yeah. Yeah. If that.
But you got to look at this angle too, is you're doing this only on quality companies that you would actually want 100 shares of.
Absolutely.
Don't do this on SoFi. Don't do it on Roblox. Don't do it on anything you don't really actually want to own 100 shares of indefinitely long term.
I've probably made hundreds, if not thousands, of these trades, and I will tell you, I've only gotten stuck on a stock one time where it dropped massively, and that was the Facebook 20% drop.
Oof. Yeah. On
That's the one that got me. But it was when I do my cash secured puts, I do it at a 10 to 15% discount, which means on the 20% drop, I was only
really
down
10.
5%.
Yeah, 5. Yeah, if you're doing true. So it's not
And
that big of a
so I was
hit.
able to get out of Facebook relatively quickly within a couple months.
And you really mitigated the downside too on it.
Absolutely. And the money you make on the premium actually lowers the cost average even more than 15%.
Right. And like you said, on the hundreds and thousands of trades that you've taken on that, you've only had a few of those really go bust on you. So it's still got a great win ratio. It's still more profitable than, the downside aspect of it.
And I'll tell you, I average eight premiums per round trip.
8 premiums per round trip. Oh, wow.
So the full getting filled on put, getting filled on call on the call side, I average 8.
So here's what I'm going to do is, from our conversation, I'm going to just pay you $2,500 a week, and we're going to talk about this.
And I mean, but in all honesty, I mean, if you average, let's say 8 at a 10%, now I'm not doing 14 days, and so I'm going to move it out to like 42 days. And take a look at, I got Apple up, so I'm gonna do Apple.
Going 4 days out. You say you played 10 to 15% from the price. You'd be looking at, maybe a 130.
There we go. So 10%, what's $14? So yeah, so 130 area. So I got to go.
And do you play every like 130, 135, 140, or will you play the in betweens like a 131? Does it really matter?
It doesn't matter. They're mathematically all the same, percentage wise.
Okay.
And so yeah, so you'd make at a 130, you'd make $2.50.
Yep.
On the 42-day December 2nd option. Now you make $2.50, so it's $250.
They're taking $13,000 and reserving.
Now you have to hold $13,000 in your account if you're doing this cash secured.
Okay, you have to actually have cash settled 13 grand in the account. That's
because you got to be able to have enough for your strike.
Okay.
And everything. So 130 is a strike times 100. So that's how you get 13,000.
Okay.
And everything. But 13K, and remember you're making $250. And let's assume you make $250 every time. 8 times. With the same $13,000. You're going to make $2,000 over a year span, around 45 days, on $13,000.
Not a bad return.
2,000 divided by 13K.
That's 20%. That's
15.3% return.
That's not a bad return on 13,000. Just rinsing and repeating every 45 days. That's every month and a half. You're doing,
and that's
maybe
assuming
6 of these a year. 7 of these is what you would fit in a year.
Yeah, per money allocated.
And that's
assuming that you don't make any money on the call side when you sell it.
What do you mean? Explain that further. When you on the call side, when you sell it, when you actually write covered calls.
So all right. So on this particular strategy, let's say it's 145. That is what Apple is. It's 130 is the put. Let's just assume in a perfect world, you got filled after X amount of premium. We're gonna say we got 8 premiums for the whole round trip.
And boom.
So
you took the 100 shares at 130 because it come crashing down for some reason.
Yep. So we got 130 and everything. And so let's just say the stock is worth 125. So it's not perfect numbers, but your entry is at 130. Entry is 130. Stock price is 125. So then you go onto the call side and you look at all right. So right now the price is 145. So to look at numbers, let's imagine 145 is 130 and everything. So we're gonna go let's say $10 into our favor and everything, and go 130 to 140. So that means going 145 to 150, 155.
150. So you're playing $10. Okay, 150. You would actually write a covered call at 155 and take that $300 premium.
Yep, 305. So now you make,
and that's still above your cost basis too.
That's still above my cost because I'm doing it at 140 and everything. I'm selling at 140.
You
and
can't
so
really lose.
You make another $300.
Right.
And so let's just for perfect numbers, let's say you made 250, 250, and 250 all on the put side.
Yeah.
So you made $1,000 on the put side. And then you got filled on the 4th one. And now you're doing the call side. Now you're making 300 on the call side.
And you're still selling that above your cost basis. So even if you have to sell those shares, you're still getting you know, say 100 shares and you a $5 difference, that's still another $500 on top of the premium that you collected from the call.
Absolutely. And so now you're up
you can't really lose
$2,200 in premium.
Gotcha.
It cost you $13,000 initially to buy them. So let's just take the premium out and subtract it by the cost basis of $13,000. So now you're at $10,800, which is a 108 entry now. So it's no longer a 130 entry because of all the premiums you've made. Now your entry is actually 108.
Huh.
And so you're at 108, which is $10,800, because you're just, instead of putting the premium as a profit, you're just in your head, you're averaging down on Amazon. Because what happens if Amazon keeps dropping?
Amazon or Apple?
I'm sorry, Apple.
Apple. Okay.
What happens if Apple keeps dropping? Well, you're not gonna be able to sell it at that 140.
No, because there's going to be nothing there to get. No premium.
Correct. So you need to keep averaging down in worst case to be able to make that profit on it. So right now you're at 108, and which is $22, even under what your cost basis was originally.
Right. Yeah.
And so that's worst case scenario. What's best case? Well, best case is Apple goes back up, and let's say it goes up to 200, whatever, it doesn't matter. You're not going to get those gains, but you're going to get $10 per share because you're going to sell it. Your entry was 130. Your call was set for 140. And so you'll sell it at 140, and you'll be able to gain $10 in equity
per share
when you sell it.
So
you gain $2,200 on premium, and you gain $10 per share on the actual stock. So you make $3,200 on the full round trip
per year, and that's only utilizing on average for the scenario $13,000.
Correct. Yep. That's a 24.6% return.
And that's not bad, and that's very passive, and that's very simple. And you do it on quality companies, to where it's like
I do it on quality companies, and I do. It's best to do it around earnings time
because the implied volatilities.
Because the implied volatilities, 2 to 3 times,
or if the VIX
what it normally would be.
Yeah, the VIX is moving up to over, north of 38. I think north of 40 is when the premiums start getting juiced up as well. When the VIX is
as well, yes, but I'm talking specifically on stocks alone.
Gotcha.
Mm-hmm.
That's smart, man. Now, do you have a list of these that you actually do it on, or do you just kind of pick and choose when the time comes, or there are only like maybe say 10 stocks that you actually do this on?
I do this on stocks that I only want to own. So
gotcha. Apple,
Amazon, Google, Nvidia, Facebook, not Tesla because Tesla moves too much. Not Netflix because that moves too much. But yeah,
a lot of the slow movers that aren't as volatile, but you want to own them long term.
McDonald's, Costco, Cisco.
Costco's a good one. Like CRM or anything like that. Yeah, you're really looking at those quality companies.
Absolutely.
Yeah. Now, how many of these do you put on at a time, if you don't mind me asking? Do you have like multiple cash secured puts out there at a time, 5, 10? Or
yes.
Oh, you do?
Oh, yeah.
Gotcha.
Oh, yeah. Mm-hmm.
Now, yeah, I mean, hard to manage at times, or is that pretty simple to manage? 20 of these positions?
It's really simple to manage. I mean, what I also do is a lot of manage. When you manage the stock. So I rarely wait till expiration. Rarely. So
do what?
Like Apple, for instance, I'll put Apple on right now. And let's say Apple pops $10, $20 after the earnings next week. That thing's going to be worth like 20 cents.
The premium.
So the $4 that I got, $400 I got per contract, is now going to be only worth 20 cents. I'll close that trade in a heartbeat because it's not worth holding for another 45 days to acquire the last 20 cents.
I see what you're saying. For the last 20 cents. Yeah. If you see that ahead of time, you'll go ahead and be like, yeah, it's 20, 30 bucks, whatever. Let's close it out now. You still collect the difference between what you collected and what you had to pay.
And honestly, normally when I'm
42
over
days
50%,
out, even on
I'll
something
close
like that. You play every 45 days. You don't play anything closer to 45 days?
No. It just depends on the math. In certain circumstances, the 15 to 12 day is better than the 45 because mathematically, percentage wise of holding money, that it just worked out better in my favor. to do it that way.
And you're only talking around earnings. That's it. Just around earnings.
Yeah, only earnings.
And you're talking maybe like a couple of weeks ahead of earnings. You'll play maybe a 15 to 20 day out at the soonest. If the
At
math.
the soonest.
Gotcha.
At the soonest, yeah.
And what are you looking
because
for?
I wanted to be able to return back to normal levels. Because it returning back to normal levels is the benefit is strictly for me.
Now the stock's price or the premium?
The premium levels.
The premium
so
returning back to normal
yeah,
levels.
so that $4
inflated,
option.
Right, because they're inflated ahead of earnings.
Absolutely.
You're getting premium. You want them to return to normal levels, which is going to, again, take those, or make you more profitable. I gotcha.
Absolutely.
Just really breaking this down for new members that are listening. Yep.
If the stock stays flat through earnings and through the next week, I'm not talking about just has to stay plateaued, but ebbs and flows, ups and downs, and after a week and a half, it's pretty much where it was pre-earnings time. And when that happens, if I look at that option, it's going to be worth pennies on the original dollar.
Oh, absolutely. Worthless.
Not just because of theta, but just because of the implied volatility is down, drastically down.
It's pushing you further out of the money. Yeah, absolutely.
So you got theta on your side, you got time on your side, and I mean, you have a good 10% of profit margin as well to play with.
Yeah, and so for everybody listening here, to keep it simple in the beginning, you could just go with about a 45-day out, and that buys you plenty of time, even ahead of earnings, from like an implied volatility standpoint.
Yep.
Gotcha. You don't want to play anything further out, and ideally don't play anything too close.
I mean, I've done 90 days.
Okay. But you had a lot of time to sit there and see those move in your favor.
Mm-hmm.
Yeah.
And I have found, again, it's a catch-22. Sometimes it's great because you get more money up front.
On the further out, yep.
Yeah. But in the downside is
it takes more time.
It takes so much time, so you're not gonna be able to put any other option plays on there because you're stuck for those 90 days with that one play.
Unless you rebuy it and you what's the profit? Yeah, like how much has it moved? Being that far out on something like Apple. Yeah, of course. So you got to find a sweet spot based on exactly.
A 130 on a 91-day out right now is $4.95. So I'll call it $5
on a 130, $5,
and that's 190 days out.
So it's about double than the 40. Yeah, it's about 100% more going.
Yep.
Another pretty long time out. Another almost 3 times. Oh, my math.
But I would rather try and capture another 45, because if the stock goes a certain direction in my favor or whatnot, I'll be able to close the trade quicker on a 45-day.
Yeah, and because like you said, the theta is going to take more of an impact. You're closer to expiration, so you'll see those go a lot closer to the pennies on the dollar, like you said.
Mm-hmm. And there's certain stocks that I'll just play all year round, even without earnings being implied. I mean, earnings makes it even better.
Oh yeah, for the premium and the payout, absolutely.
But yeah, I mean, I don't have cash just sitting in cash. I literally just have nothing but cash secured puts in my account.
Yeah, never sitting on cash, always doing something with it. Quality company, absolutely. Oh, that's smart, man. And you just rinse and repeat. That's it. Rinse and repeat every time. Either you get the exerciser assigned, you go ahead and just write those calls, and you just rinse and repeat with another maybe 45-day output contract, and you just kind of rinse and repeat.
Absolutely.
Okay, simple stuff, man. Especially on your long-term account, if you're sitting in cash, like a lot of hedge funds and portfolio managers right now have been sitting in cash the entire year. That's a lot of what they're probably doing. It's hedging your portfolio if you're not really invested in a lot.
Oh yeah. No, absolutely. And then when you start doing other stuff like iron condors, for instance, iron condors is one of the best option strategies you can learn, because if you want to actively manage your account, it is by far one of the better ones, because if you put on the condor, and basically the condor, you're trying to smush two numbers together. So if you think Apple's going to end up between 120 and 160, you put an iron condor out, one on the top side, one on the bottom side.
Gotcha.
And let's say the stock pops or drops. It really doesn't matter. Like it goes up or down massively early on in the trade. And so that's why earnings play is really great, because it will go up or down really dramatically right away. And so then if it goes up or down dramatically really quick, you close the other side of the trade for nothing, like 5 cents, 10 cents. So now your risk was both ends. Now your risk is only one side. So now you only have to manage one side of the trade.
Okay.
And within a week of this trade being on.
And again, you're still ahead of earnings because you're expecting that big pop or that big drop ahead of earnings. If it's flat, then how does that work? Okay, like you're getting a big pop or drop, that makes sense. What if it's flat and it does nothing? No big pop, no big drop. How could that impact you negatively?
Then that's great too, because if it's just sitting there, that means it's right in your wheelhouse. It's if you're 120 to 160 and it's sitting there at 140. Okay, well that's exactly where you wanted it to be.
Anyway,
when you put the trade on.
Okay.
So and every day your theta's just killing the trade.
So what's one negative takeaway? Like if there's like one negative thing you would say about the strategy or this approach, what do you think it would be?
People get too comfortable with it and they don't manage it correctly, honestly. If you manage the trade, you almost can't lose in an iron condor.
So iron condors, right. So what about, just selling cash secured puts, like what we were talking about a second ago, and then, if you get assigned, write and cover calls, what would be like a really big negative takeaway from that the trader should be mindful
of? The two
of?
most dangerous things in selling puts is people do it so much and they make a really good return because the market keeps going up and they don't get filled. They get too excited and too greedy and they forget about the cash secured side. And they just keep putting selling puts, and it's called naked puts. And then the market turns.
Then they start getting assigned. They don't have the cash, and they're like, "What do I?"
And they get margin called. Yeah, it gets ugly really, really quick.
It's just if you're not mindful about how much capital needs to be mentally set aside. Apple, for example, would strike 13 grand. You always make sure you have 13 grand settled, and you're playing it super safe.
And the only other negative is. People freak out. So like on Apple, if you wanted to own Apple at 130 and you put a cash secured in there at 130 and Apple dropped to 100 after earnings, dropped $40 and everything, people crumble and just freak out and are just really angry because it went down. And
would you close that position before getting assigned? Let's say that did happen. You sold a 130 put. Earnings hit, it opens at 100. Can you actually go rebuy that put contract?
Yes, absolutely.
Well, yeah. So
I mean, you'll have to take the $40. You're gonna take the $30 loss per share.
What do you mean?
Well, whatever the option is to buy it, so you're gonna lose money. So let's say it costs you $4 or I'm sorry, not cost you. You made $4 on the sell originally, and let's just say.
It's worth $1. It's worth 50 cents.
Well, no, because you have to buy it back, so it might be like $14.
Like actually, like $14.
Right.
Right. So you're gonna lose $400. The entire premium that you collected, right?
Well, not only so you would have to buy. Let's say the premium on that to close that trade is $12. So you'd lose $800 to close that trade.
How does that make sense? So you sell the cash secured put, you get $400 credit in your pocket.
Yep. Remember, so it's a put side. So when it goes down, the premium goes up.
So
I see. If it goes down to $100, it's no longer going to be $4. It's going to be like $12, $15, $16, something like that.
Yeah, 100. So you'd have to actually spend, $1,500 or so it'd be $1,000 loss. But you put that in perspective. At that point in time, you make a decision like, do I go ahead and take $1,000 loss right now, or do I get assigned those 100 shares and be down, say, $3,000 on the position once you actually take delivery at 130 and the price is at 100? So you have flexibility. You have options. You don't have to.
You have options. It's a losing position no matter what way you look at it. The best way is your hope. I mean, and something such as that, I leave the trade open because I hope theta decays that trade more and more throughout the days,
where your loss is less and less and less, and who knows, maybe it bounces back up.
Yep, if it bounces back up,
but mandatory. You have the option to take the shares and you're assigned, or you can close the position by rebuying that contract.
Yeah, and every day it's going to decay 20, 30 cents.
I learned something new today. I didn't know that. I thought it was like mandatory that you have to take those 100 shares, but you have flexibility there. Okay.
You have the option to close the trade even after they get exercised.
Cool. I learned something new today. I'm sure a lot of members inside the chat did as well. Good shit.
So,
hey, so I'm gonna go ahead and sell myself a little an Apple cash secured put today, man. I'm gonna
there you go.
Get my feet wet. I'll go 40 some days out, 42 days out, 130. Play the 10%, and get my feet wet. Nice. We'll see what happens. Cool.
Yeah, sounds good. Well, hey, I got to run, but I wanted to. I mean, with all the earnings coming up, I figured it might be worth mentioning.
No, absolutely. Like you said, it's a nice little premium. People that are sitting on cash in the long-term portfolios, there's a way to definitely make some passive income, stress-free. Yep. Absolutely. Appreciate you, man.
All right, man. I'll catch you.
Have a good one. Have a good weekend. H. What's up, H? You can unmute yourself, boss.
Sorry. Does that apply only for the premiums, or can you do something with like small amount of on money for options?
Yeah, so basically the way it's working, like on the Apple example, is every options contract is based around 100 shares. So if you look at the strike price, for example, it's 135, so $135 per share times the 100 shares, it would be $13,500. You would actually have to have in your account cash to be able to do something like this on Apple. And based on the conversation, is you only want to do this on quality companies that you want to own long term. So you can do this with lower priced stocks, which is not going to cost you as much. Let's say, for example, that you have I'm just going to give you an example, like AMPX, right? You could technically do it with AMPX if you wanted to, but here's the thing, right? Do you want to own AMPX long term? Probably not, right? You could go here. It's 100 shares. $10 strike, right? What is that? That's $1,000, right? So it's not as expensive as Apple. It's only $1,000. You can do that with a small amount of money. But the thing is, do you want to own AMPX long term? The answer to that's most likely no. So it's really hard to do this with small amounts of money, especially when you're looking at NVIDIA, Tesla. I know he said he doesn't do Tesla, Apple, Amazon, because they're well over $100 per share.
All right, so like my example, I own 40 shares of Amazon.
You own 40 shares of Amazon, okay?
Yeah, my cost base is I think 127.
127 cost basis, okay?
Yeah, right now. I'm planning. I was telling you guys the other day. I was planning to like add more to lower my average down my cost base, but I'm willing to do like try to start like learning some options and see like like how can I start working on and learning more about options.
I see what you're
so
saying.
Let's say I have an extra $1,000 to either buy more Amazon or Google, but I would like to do what could be my best option, like either like just buy them to own them or do some options with it.
So let me ask you this question. If you were to do like an option strategy with it, for example, hypothetically, what would be the outcome you want? To actually own $1,000 more worth of Amazon, or just to make passive income by doing option strategies with Amazon and not owning more?
Well, for me right now it's like I'm just trying to little by little adding like saving some money so I can add more for my loan portfolio.
You actually want to own those shares. You actually want to own 10, 20, 100,000 shares of Amazon. That's your end goal.
I mean, at some point, yes.
Okay.
But if I can do some passive income with it, like because like I know they want to leave the money there for like 1, 2, 3 years, 4 years, like that's my question, like what would it do, like doing some options with that money right now, or just buy some more Amazon?
That's a tough question, right? So, do you want to trade options for quicker, shorter term profits, right? To build up your capital to be able to buy more Amazon? Or do you just want to go ahead and buy Amazon and hold it long term? And your question is, if I'm just buying up Amazon long term, is there anything that I can do from the option side of things, right? Can I sell, those cash secured puts to get that premium And if Amazon comes down to $100 a share anyway, I'm going to buy more shares at 100, right? It would make sense. But from your perspective, you would have to be buying 100 shares at a time, not 10 shares at a time. Because remember that if that was your end goal, was to make passive income, but still own more shares of Amazon, you could sell those cash secured puts, but they're based around 100 shares. Or when you get to 100 shares of Amazon, then you could start writing calls. Those are called covered calls, and be able to collect a premium to write those covered calls because you do have 100 shares at that point in time to do so. But every option contract is going to be based around 100 shares. So you'd have to be wanting to buy 100 shares of Amazon or own 100 shares of Amazon to actually write those covered calls. So I mean, there may be other ways from an option standpoint with low amounts of capital, say $1,000, right? But I don't know if any of those approaches or strategies allocate you shares at the end. And that's kind of what it seems like you're aiming for. You want to make some passive income, maybe like a premium, get a premium, but you still want to put that money to work and own more Amazon at the same time to build your portfolio. If I'm not mistaken on that, then I would say that you'd have to get to that point of being able to purchase 100 shares at a time and reserve that cash in your account, or just continue to accumulate your position week after week, month over month, until you get 100, 200 shares, and then you can start selling those calls to make passive income on the shares that you already own at that point.
Okay, thank you. Yeah, I mean, it's like I got to the point right now where I still have like my small cash account which I'm using to do like penny stocks, and I have like my long-term account where I start like saving little by little.
Beautiful, I love it.
And but now I'm like, I have this money. I'm still waiting for Amazon to drop so I can buy some more.
You're like, what do I do in the meantime, right? With that money, what do I do in the meantime? So yeah, and have you ever traded, like actually traded or day traded or swung trade an option before?
No, I'm still digging on it because you know, the 20-minute delay on the paper trading is kind of hard for me, and I'm right now I've been focusing more on my strategies on penny stocks. So I don't want to leave that alone right now, because then I'm gonna maybe lose, you know, the track or what I'm doing.
I would perfect what you're working on, absolutely, because you've been crushing it lately, and it seems like you're really perfecting your edge and what works with penny stocks, which is amazing. I would say like the last thing you want to do is distract yourself from what you're doing now and what's working to bleed into options. Options are a completely different animal, completely different game. But I would still not, you know, say procrastinate or anything. I would still continue to educate yourself when it comes to options. The best thing that you can do is watch every single lesson in the video lessons library that pertains to options. Understand the risks associated with options, understand what they are, how they work, how to trade them, strategies behind them, as you're still perfecting your edge with pennies. And once you've got that down pat, you're confident, then it's time to maybe start putting a little bit more of your attention into options. But they move quick, they move fast. You could lose a lot of money quick with an option. So they're really different than just trading with physical shares, for example.
Great, thank you for the advice. I will study, keep doing what I'm doing right now, and I keep saving just to have. I better have the money to start investing than don't have it and be ready to start trading.
Absolutely, and you know, and everybody, this is tough to say because we all day trade, right? But investing should be everybody's primary focus. Right? Everybody should be investing something into their long-term accounts for themselves, their retirement, for their kids, their family. Investing should be everybody's, like, their first step in the market is, I need to invest. I need to allocate some into these, whatever that is. Could be real estate, could be assets like the stock market, equities, could be cryptocurrency, but actually investing for the long term. Okay? Then it comes down into like active trading to produce more active, quicker income to then allocate towards those investments. So it's tough, right? Because I want to say, yes, dive into options right now. Start trading options right now. You got a couple grand laying around. That's all you need. Options aren't expensive. You can make a lot of money trading options with a couple of $1,000s in a cash account. You can do really good. But options are tricky. Options are going to be just like penny stocks were a couple of months ago, where you're still trying to figure out what your edge is. You may see some inconsistency. You're not confident. It's definitely not something that you're going to jump into and in the first week, in my opinion. you're crushing it. It's going to take a little bit of time. You still need to back test the paper trade. You need to get more educated. But if you can do that while not taking your focus away from really continuing to perfect what's already working, and you can do both of those things and give them ample amounts of focus, not distract yourself. Because what you're going to do if you do distract yourself and you take your focus away from what you've been doing, you may see your results dropping while you're not seeing the results that you want to see with options. And now you feel like nothing's working. The results are diminishing on and you're not really seeing those options. There's no good balance there. You're just going to maybe feel you're just out of balance. Does that make sense? But if you just put a lot of your focus where it should be on perfecting what's been working, but still give some time and energy and focus to the education side of options, you're still growing at a nice pace with both of those consistently, and having good balance versus everything seeming out of whack. Hopefully that perspective kind of allows you to open your eyes a little bit.
It does. Thank you very much, Josh.
Absolutely. Absolutely. Corey, you're good, bro.
Yeah, I was just going to add something on Matt's strategy about, especially around earnings, taking advantage of like the IV crush and stuff. The reason that I'm sure he's so successful at it and why it works so well is if you think of it from a probability standpoint of the stock goes up, stock goes down, stock stays the same. Like it can only do one of those three things, basically.
Yeah, exactly.
If you sell a put, 2 out of those 3 things are going to be in your favor. If it goes up, cool. You don't get assigned, you get to keep your money, or you can buy back the contract for a super tiny premium. If it stays the same, theta eats away at it and you still don't get assigned. So you're profiting on 2 out of 3 scenarios. And when you take advantage of the earnings implied volatility, even if it goes the wrong way and it goes south against you, if the IV crush is heavy enough, you're still not going to get hurt by it. And that's a big thing around the earnings side.
Is back down and the stock, stabilized.
Yep. We've all heard of IV crush. Yep. When you buy an option, it's like, oh, I'm going to buy a put and the stock plummets. And then when the market opens the next day, your contract is worthless. You're like, well, what happened? The contract or the price went down $20 on the stock.
That's going to benefit you as an option seller.
It's exactly selling it. You take advantage of that IV.
So if you really, simplify that out, 66% win rate with that strategy across the board, because like you said, there's only 3 things that could happen. Stock goes up, sits sideways, goes down. 2 of those 3, you're making money. 1 of them, you have to kind of like, all right, what do I do?
It's a risk. It's a risk on 1/3 of them. And if you time it right with the IV properly, that third risk is probably closer to like maybe 20%. Because even if it goes down a little bit, the IV kills the premium cost.
Right.
Even if you go slightly in the money, maybe you can still buy the contract out for cheaper than what the premium was you paid. You're not going to make a bunch of money, but you're not going to get smacked either.
Right. And the other additive that I always want to add to this for newer individuals listening is it's a quality company you want to own long-term anyway. So if you really
right, yeah, don't do it on something goofy. Do it on a company that you're okay holding.
And then what Matt said earlier is, you take those 100 shares that you were assigned that you own, and now you start writing covered calls for them above what you paid to where you can still make money on the premium side. And if you have to sell those, it's still above, what you own them at as far as your cost basis. So everything that you look at from your perspective too, it just kind of de-risks the whole, this type of strategy and this kind of approach market.
Yep.
Doesn't really seem like there's a lot of risk unless, Amazon, were to go down to $50 and you're like, well, fuck.
Right. And like Matt just typed up, you're selling them at a discounted price. So it's like, you go to a store, it's like, oh shit, these shoes are 20% off. Cool. Yep. Like Apple's 20% off if you sell the right contract. So you're getting it cheap if you have to get assigned.
If you have to, exactly. And that's one thing I wish I would have done for sure as a newer trader. Even just like being experienced, the time to allocate my focus to continue to educate myself in the options space. I've always taken the time to educate myself from an analysis, like technical analysis, mindset, psychology, thinking, everything like that. And I've never taken the time to actually focus more on options, which is unfortunate. Now, if I would have done that a couple of years ago, like Matt was saying, like if you just do that, 7, 8, 9 times a year, every 45 days on something like Apple, and you really look at how much money you're setting aside on average based on the strike price that you're selling, and you're just like 25%, 20% on your investment, and it's very passive. You're just really sitting back and letting your money work for you, especially if it's just sitting in cash to offset inflation, and it's a decent return on the cash that's just kind of sitting around. 20%, not bad. No, this is good stuff, guys. Oh, Matt's still back here. Plus, you're selling at a strike that has a 5 to 15% discount, right? So you are a 66% chance of winning the discount. They're more than 80 to 85% win. Yeah, it's fantastic. I appreciate you jumping on and being a little bit more thorough there and kind of adding on to what Matt said. Not my field of expertise, but it's really nice to know that we have very, very smart, educated individuals in here that know a lot about options and more advanced option strategies for those of you that want to continue to grow your knowledge with options.
I had about 5 or 6 things that I was going to add as he was going through that with you guys. And then he just kept hitting them and I just kept crossing them off my list. So he was chipping away at everything I was going to say anyway.
I love it. You guys are always holding it down. You guys are amazing.
Hey, Josh, this is Steve.
Steve, what's up?
You know, I've been paper trading the options and stuff. And in the first 8 days of the month, 8 trading days that I did, I averaged, what was it? 464 on average per day.
464 bucks?
Yeah.
Nice.
Then I went to the live account, and in 6 days, I'm down. It's like negative 137 on an average.
On it per day, down 137. Okay.
And and one of the days I jumped back into the paper trading account when I was down, and when I just doing the same thing that I've been doing and stuff with the options, and I made like $400, and I'm only trading like 1 or 2 contracts. And there's a big difference in going from the paper trading to the live trading on the options. Now, granted, some of those losses I cut, and they could have turned into winners because I got scared out of the trade and stuff. But doing that paper trading, it made it so easy. Like it's like, why not do that versus the penny stocks?
Right. No,
and now I'm really struggling with it.
Struggling. Do you think it has a lot to do with you knowing you're going from a fake account to where you could lose indefinitely and it not bother you, but now you're going into a live funded account to where those losses you have a bit of an emotional connection to? Or do you think there's just a big difference in, you know, how the fills are being calculated, right? Do you think there's a big discrepancy in the paper account making it look like you're making $400, but in reality, it's just because the fills aren't legitimate, the fills are not accurate, for example? What do you think it is?
Well, I think it's both. On
both.
The paper account, I noticed that the fill would be right at, I mean, the price wouldn't even be at the price of the fill yet. On the chart,
already put you in the green, probably. You would enter the trade and already be pretty nice in the green on that trade. On the
exactly,
paper account. Yep.
Exactly.
Because it's probably filling you on the last order that's come through. It's probably filling you on bid, and then it's, you know, the P&L is going to reflect on the last, right? So it's already going to show that you have a little bit of profit on a paper account for sure.
Yeah.
Yeah, it's not realistic. And then a little bit of maybe a mindset, emotional thing with the real money.
Yeah. Yes. Because I mean, there's been some trades that I've done that I've cut them, and then I just watch it, and it would have turned green, and I would have made money on the trade.
You would have made money. Gotcha. So when you come into these trades, how many contracts at a time do you think you're trading?
One
at a time. Fantastic. And what are you trading? SPY, Qs, individual stuff?
Only the SPY.
Only the SPY, 1 contract at a time. Yep. What delta are you playing?
I'm trying to do around the 30 delta.
Okay.
30 to 35.
30-35 delta, 1 contract, the SPY, calls or puts, and you're playing, I assume, closest to expiration?
Yes, same day.
Same day until expiration. So those contracts are probably, you know, anywhere from $1.50 to $2 a piece. So your upfront investment is about $150 to $200.
Correct.
Okay, and you said your average loss over the last 7 days is around 113 on average per day.
Yeah, 138.
138 on average per day, one contract, and your average investment is 100. So the first thing that stands out to me based on that is it seems like you're holding those really, really long and letting them basically get down to zero, right? If your average contract that you buy on a call to SPY, 0 to expiration, 30 delta, right? Let's say they're right around 150 to 200 on average is what the premium is. And if you're
Right.
averagely losing 137 a day, well, no, that's how many trades do you take a day? You're taking 1, 2, 3, 4, 5. How many do you think?
I don't have
I'm trying to
them
get an
listed
average
right here in
loss
front of
per
me.
trade, right? If you're doing 5 trades a day, I'm trying to get an idea of what you're losing per trade on average.
Well, one day I lost 325 and I've got 10 trades on options trying to understand SPY,
Gotcha.
entry, exits, and also setups.
Setups. Okay.
That was on the 17th. And then one day I did 3 trades and I was down $27.
Okay. So it's not like it's straight 130. You had a pretty big loss, some smaller ones, but that brought your average up to 138. So, and the reason I was asking those questions because, you know, at first I was maybe thinking that, wow, you're going in about $1.50 to $2 per contract, one contract. That's about a $200 investment. And on average, you're in 138, which is a big percentage. Basically letting those go to zero, which is not the case, right? Because you have several trades and some of those days had been larger than others. So I think Skylar had a good point. I just kind of looked over inside a chat. Do you feel any like hesitation when you're entering? Like you look at the SPY, you see a good setup, you've built the plan, right? I want to get in here. My stop loss is $1 higher, right? I know my delta's a 30, so I'm losing $30 per contract. I'm only taking one contract, so my loss is 30. But do you feel any kind of like hesitation with actually like pulling that trigger?
Yes and no. Sometimes yes, sometimes I don't.
Okay. So we know it's a little bit of both, right? You've had some success on the paper account and you're not seeing the success trickle through on a live account. You're a little hesitated and you feel like some of those emotions play a little bit of a factor as well, right? Which is normal, which is absolutely normal with a live account. And that's why we start small, and you are starting small, which is amazing. If you said 5 to 10 contracts, boom, right? Step back, one contract, and do that. So I would say that the first thing that you can do to help you really limit your losses, right? Not say prevent them altogether at first, but to limit how much you're losing per day or per trade, is to set a max. How many trades am I going to take? So create a rule that says I will not take, say, 10 trades in the beginning until I build more of an emotional tolerance to the account, until I remove the hesitation and maybe some of the fear that's causing me to, say, get in late or make bad decisions, right? Really prevent how many trades you're going to allow yourself to take on any given day when it comes to options. And then when you're done, and you can put your focus back on penny stocks where you have more consistency with, right? Because you've been doing it for a little bit longer. And then what does that rule look like? Is that 2 to 3 trades a day? I think that's perfect. Give yourself a set amount of capital that you're going to use for options only, and then create a rule around how many trades I will take. That's going to limit the over trading. That's going to eliminate some of the emotions that may come into the over trading, the revenge trading that you felt on the day that you took 10 contracts, and have a set dollar amount stop, right? Based on that, based on how many trades you're taking, and based on for options, right? If that's $100 a day, that's your daily max loss. And you have, say, 3 trades a day max. So let's say that's what your rule was. Okay, you're going to lose $100 a day is your max loss when you're done trading options. Only 3 option contracts a day is my max. And you know that you're trading one contract at a time that has a 30 delta. So you know that the types of trades that you have to take, for example, you can only risk $1 on the SPY. That get in at 116, stops at 117. That one contract, because if the contract goes up $1, you lose $30 on that one trade, times 3 trades. That's your max. That puts you at a $90 loss for the day. That's your $100 walk away. So maybe have a little bit of a mental structure like that, to where that's going to make sure that you're only taking the best of the best setups, because you only got 3 trades you can take. So they have to be crystal clear with the lowest amount of risk. You only have $1 breathing room, hypothetically, if that's your plan. So they have to be really sweet entries to where there's no hesitation allowed. That's going to help you maybe keep your emotions in check as well, with knowing that you have some provisions and some rules until you start to see more consistency with the live account, which is really inevitable. At the end of the day, the more you do it and the more you look back and review, the more you're going to see what you can do better, and you're just going to see progress. But that's going to allow you to keep your mind level-headed, keep those emotions in check, never feel like you're revenge trading or losing that you can't bounce back from. And that puts you at an average loss per week. Let's say you just have a really bad week Monday, Friday. Your maximum loss for that week, the options is $500 if you're going $100 a day. Now you have to ask yourself, is that too much? Can I afford to lose $500 a week to continue to get this consistency under my belt? Really just depends, again, on kind of what feels right to you and your account size and what you're willing to risk and your tolerance.
I wish there's a way that I could scale out of these contracts, but with one contract, you can't.
With one, you can't. Exactly. Now, another thing I wanted to hit on real quick is, are you trading options in your main account where you also trade penny stocks, or are these two accounts separated?
No, this is separate. This is just only for options.
Options. Okay. And it's nothing like, you don't have like 10, 20 grand in there on a margin account, right? I hope
no,
not.
it's
okay.
it's in one of my IRAs.
Gotcha. Okay. So another recommendation that's helped a lot of traders in the community over the years, and that helped me, is taking $1,000 in its own unique account, not in an IRA, nothing that has investment. It's just a complete $1,000 cash account. There's nothing else going on. $1,000, and that's the only account that I trade options with. And that's your practice time, right? $500, $1,000, you can trade a lot, right? I mean, and your cash settles overnight as well, which is beautiful. So if you use your entire $1,000 on Monday, you have it again on Tuesday, Wednesday, Thursday, Friday. There's no extra day settlement. And that's just going to keep all of that data and all of that, the win ratios, the average losses, all kind of just consolidated in one account. And you know that this is the only account that you're trading options with right now. And you have thresholds, and you could base rules and plans and everything around that one account with $1,000 in it, and have a really nice structure and a really nice game plan as you start applying what you learned in the paper account in this simulated account. And you're not looking for, $200, $300, $400 days. You're looking for maybe $50 a day, right? Maybe $100. But your risk is going to be maybe $25 a day, maybe $50 a day. And really structure this like a small account, as if we were really starting with $1,000 and it was a small account. Really structure it that way. And I think that structure is going to help allow you to have a little bit of a better mindset around it, the types of trades that you're taking from it's all about consistency standpoint, not about the profit. And when you actually see the consistency, right, it's going to make you feel a lot better to start maybe adding to that account to see profit in the coming weeks and months. I think that would be a huge help. Maybe just bring it back to the basics there.
Well, that's what I did when I was going to start trading options, is I opened up a $1,000 account, and I went through Ameritrade, and I told them specifically what I was going to use the account for trading options. You got to fill out these questions and stuff.
Yep. The
And
form and all that.
as I was going through, I asked him, I want to make sure that I'm answering these questions right, so I get approved for options. And so we went through the process, and he's got it set up, and he says, okay, you're all set up. I funded the account that same day. And then I go in a day or two later. I wanted to make sure that the funds had already settled, because I moved them from out of my checking account in there. And he said that with my other accounts that I have, that there would be no issues whatsoever, because I have such large accounts in two other accounts.
Two other accounts, yeah.
In one other account, actually.
Right.
And so I went to an option trade, and it wouldn't let me do it. And then so I go back and I look, and it says I'm not approved for options.
Huh.
So I had to call them back, and he got me approved in one of my IRA accounts, my smaller IRA accounts,
Gotcha. Okay.
and I funded that to get it up over the $25,000 threshold, because I got flagged the first day for 3-day trades.
Under the
when I
25, because it
was
was on a
in-
margin account, but under 25. Yeah, makes sense.
It was in my IRA, yeah.
IRA. Gotcha. Okay. Yeah.
So
Yeah. Go ahead.
now I've got this $1,000 cash account that I set up for these options, and I can't trade the options in them.
I'd give him a call
But they
back.
turned
yeah.
around and let me do it in one of my other accounts, which doesn't make sense.
No, it doesn't. Yeah, I would definitely call back and maybe get a different representative. Say, hey, I'm just coming out of a simulated account into a live account, and I want to make sure that I'm doing this the right way. I have an account that has $1,000 in it. It's a cash account, which is what it needs to be, is cash, not margin, cash. It's got $1,000. You need to get it approved for options and have them help you with the approval. And once that's solidified, you'll have a cash account, $1,000, options only, which is fantastic. And then you could actually structure your trading options around that account, right? 2 to 3% per trade, 20 to $30. And we'll be able to get more of a foundation and more of a structure built when, you're really just only in that account. That's only your options account's $1,000 and it's cash. And we can actually structure 2 to 3 trades a day, what your daily walk away is, profit target is. What are some strategies, and really create a foundation strong around this to kind of get some consistency under your belt. That's the only thing you need, is just some consistency. If you're making $10 a day consistent, that's all that matters. That's the first step. Then 20, then 40. And before you know it, it takes some time, 3, 4, 5, 6 months. But before you know it, you're going to blink. Freaking 6 months from now, you're doing $200, $300 a day consistently, but it started small, $10, $20 a day. $20 a day with $1,000 account. And now you have a $10,000 account and you're banging out $200, $300 a day. I think that would be the best, is starting, wiping the slate clean, fresh account, $1,000 cash. You already spent some time in a paper account, which is great. You already kind of have an idea of how options work, the strategies that work for you, one contract. You got the discipline down pat. But I say we just start building on this strong foundation now. Before you know it, you'll start to see that account grow. Your confidence will build. You can start going to 2 contracts, then 3, 4, 5. Before you know it, maybe you're trading 30 like Matt, and you're crushing it. But you got to start somewhere, and it's going to take a little bit of time in the beginning, but I think it's going to be very beneficial to you, medium to long term, 100%.
Yeah, because in the paper account, I was doing 3 contracts, so I could scale out of it.
Scale out of them, right?
But
and this
when
is
I went
different,
into
right?
the live,
Yeah.
I went back to the one contract,
which was smart, which was really, really smart to do that, for sure. Not going 3 to 5 contracts in a paper account, then a live account, because then we can, 3x, at your average daily loss, if that were the case. Matt made a really good point. He goes, if you're having a hard time going from paper to real, which there's a lot of things that it could be, but it's awesome to see members really stepping up. Your size is off. I know you said 1 to 2 contracts, but maybe your delta is too high. He suggests maybe going down to a lower delta to allow you to get your feet wet. So for example, if your per trade plan is to not lose more than, say, $30 per trade, and you're going with a 30 delta, that means you can only let the stock move $1 before you get stopped out. But let's say that's not realistic, and you need to let it breathe $1.50. Okay, so you're going to say $2 is my risk, hypothetically. Well, you couldn't take that contract with a 30 delta, because that would be a $60 loss. That's times greater than what you're allowed. So what you'd have to do at that point is go to a 15 delta, right? Because that 15 delta times the $2 move would be the $30. So play around with those deltas, maybe go back on the delta a little bit if you have to allow the stock to breathe a little bit more based on what strategy you're trading and what your game plan is at that point in time. So that's super smart. I love that approach. I think the other thing as well is, we can sit down like on another one of these calls, like Friday, when you have all this structured out, and we'll actually work one-on-one and say, okay, this is your account. How many trades a day, right? What's your max loss per trade? And create some rules and a structure and a foundation around you trading options. and let's start this the right way from day one, in a sense. Restart, refresh, strong foundation, and let's grow from there the right way. I think you're going to see a lot more success, and that's going to help out with maybe some of those emotions, and maybe some of the over trading if you felt that, or the hesitation. I think.
All right, perfect.
Sound
Thank
good?
you very much.
Yeah, absolutely. So yeah, some point next week when you're ready, we'll throw up another Zoom, and we'll make it happen.
Okay.
And if anybody else has any advice, not really advice, but recommendations, greatly appreciated. I think Matt really hit it on the head there. 1 to 2 contracts, you're doing one, lower that delta. That's going to allow you to let the stock breathe a little bit. Having some rules, absolutely. More 10 trades a day, maybe 2 to 3 at most. It's going to make you extra picky on what you're trading, picky on these that you get. I don't think it's a technical standpoint. Right? I don't think it has anything to do with TA. Read a chart, you can identify setup, you build your trade plan. Have discipline there. I think it really just comes down to a structure, foundation, and that delta was a great.
Okay.
Because you feel pretty confident in your technical ability, right? To like read the charts and identify the setups and build the trade plans around those particular setups.
Correct. Yes.
Yeah, I was gonna say you're very, very consistent with trading the pennies, very consistent with the options as well. But now just the big thing is it's the mindset. Not really even the mindset. It's just it is. You know deep down that this is a live account and it's real. That kind of maybe tax the judgment at times. It's natural, it happens. But we'll get you from that point to the point of how you are handling the trades on the paper account. That's the point we're gonna get. That's my goal. Big throwing out the pitfalls might hit home for you. Do you ever revenge trade and try to cover a previous loss, or even catch a trade about the previous loss? That was a good question from Skylar. Do you ever find yourself, say, revenge trading to try and cover a previous loss?
I was doing that in the paper account at one point
Were you?
in the beginning, but I quit doing that.
Not so much on the live account, like those 10 trades. You wouldn't say one of those 10 trades were a little bit of, like, say, revenge, trying to make up a loss, or those were just good setups that just unfortunately kind of went against you?
Yeah, I wasn't revenge trading.
Okay, good. So it doesn't really seem like it doesn't even seem like it's emotional. It doesn't seem like you're giving into your emotions. Like, I got to make money, or, oh, I lost, I got to make it back. It seems maybe there's a little bit of a barrier from fake to live, that it's now live money, and that may impact the hesitation at times, like you said, maybe 50-50. But I would say after, the interview, beating you up with questions, I appreciate it, by the way. But yeah, a lot of it makes sense. I think just taking that step back, strong foundation, let's put together a game plan, get prepared with this and how you want to attack this. Let's create some goals, some smart goals, and let's give yourself some deadlines as far as when you would like to accomplish these things. From a consistency standpoint, very, very small, and then we'll start scaling up little by little in the coming weeks and coming months until we get you where you actually want to be from a daily profit standpoint, and then get you into 2, 3, 4 contracts so you can scale out and maybe play around with that as well.
Great. Perfect.
Awesome. I feel good about that.
All right. Thank you.
Yeah, absolutely. All right, guys. Anything else? I know we're a little after that 11:30, but hey, like I said, I enjoy these guys. Absolutely enjoy these. If anybody else has any other questions, let me know. If not, we're going to end our sesh. All right. Good job. Good work. Nice little Friday here. Great little comeback. And I enjoyed it, guys. I enjoyed working with you. I enjoyed jumping on the mic, answering some questions. It was definitely a fun day. Definitely an education value-packed day. Matt, appreciate you. Corey, appreciate you. Steve, appreciate you as well, buddy. Appreciate all you guys. Go ahead and mute everybody on the Zoom. If anybody has any final questions, let me know here on the Zoom. If you want to raise your hand, you have something you want to add. If you have anything in chat, let me know. But if not, once again, traders, good job, good work. Way to crush it. Way to make it happen on this beautiful Friday. And we will come back and do it all over again this coming up week, guys. We got officially, 5 days until the end of the month? No, we got 6. Month ends on Monday the 31st. So we got 6 more days to go. Let's make them the best 6 days. AMPX was a good one. That was a fantastic little, I know where I want to get in, stop in the system. You have your targets. Worked out absolutely beautifully here over on AMPX. So, if you guys grabbed any AMPX, good job, good work. Netflix, that one got all the way back up to the 280s. Not really touching that one right now. Snap, I was buying a little bit here a while ago. Nvidia still may be a nice little short opportunity, but it really depends on what the SPY and the Qs do as well. So I'm still watching the SPY and the Qs to see if that's going to dictate a possible entry here to the short side on Nvidia that we've been talking about. And then AMPX is already done. That was a nice little 875 to 10 and then 1148 trade. And then Amazon. Watching Amazon here as well. All right, Joey, somebody inside the chat, go ahead and give me the countdown. Look, I said Joey. That's all I said. I said Joey, and he's on it. That's it. I said, hey, Joey. Boom. 3, 2, 1. In a big old 3, 2, 1. Woo! Good job. Good work. Way to crush it. Way to make it happen on this beautiful Friday. If you guys have any questions, you guys know where to find me. Drop me a message here inside of chat. Send me an email, members@alphadaytrading.com. All right, until next time, guys, make it happen. Love you all. Be safe out here in the market today. Enjoy your weekend. Stay blessed and take care. And I'll see you back here Monday morning, 7 a.m. All right, guys, see you then. Take care.
I can't let you go. There's no